Here we go. Let's learn this. The other thing that we do worksheet is this. There are so many adjustments in one business, 5, 10, 20, that you might easily forget something. So what you do, you prepare this worksheet, then you have an accounting department meeting with your clients, with accounting department, few CPAs, your client accountant, and you go over this worksheet to make sure everyone agrees that every single adjustment has been recognized in the worksheet. Everyone is happy. The income statement, possible income statement looks good. The possible balance sheet looks good. So this is all situation that you want to see if everyone agrees. Because in accounting, you cannot start making mistake and then later on you say, oh, oops, I forgot this, I forgot that. No, there is no oops. Because one oops, that means a lot of headache. So there is no oops. That's the difference that some people, maybe they don't like to do accounting, because in accounting, you don't have oops. In accounting, either you do it or you don't. If you want to have a oops, you can become a manager, because a manager says, oh, it was better if I did that job. I forgot. It's okay. Okay. But if you want to become an accountant, there's no oops. So remember that. Okay, here we go. First of all, cash doesn't need an adjustment. Cash, either you have it or you don't. But accounts receivable needs an adjustment. Supplies needs an adjustment, because supplies might go, less. You buy a lot of supplies, you recorded supplies. And then end of the year, you go to your supply room, you look at your supplies and you see, oh, I was supposed to have, let's say, $5,000 of supplies that I bought during the year, and I recorded that supplies. But now at the end of the year, I have just barely $1,000 worth of supplies left. So what's the difference of $5,000 that you purchased and $1,000 that is left? That is used. So we have to recognize that as supplies expense. So supply expense, you recognize it at the end of the year, okay? Supplies expense, you recognize it at the end of the year. So if you buy supplies, or let's say you buy equipment, you don't record equipment as supplies. Why? Because supplies is something that you're gonna use it as a matter of a month or 2 or 3, right? But equipment is something that you use it for many years. That's why equipment gets capitalized. What does it mean it gets capitalized? It capitalized, that means you're gonna record expense for this equipment as a form of depreciation expense in here, line 22, every year. So capitalized, that means you don't record equipment expense on year 1, but you record equipment on year 1, and every year a portion of that equipment will be depreciated and you will recognize as a depreciation expense. However, for supplies, you don't do that. Supplies are like copy paper, right? Like pen, pencil, copy paper, those type of things, ink. Those are supplies that you might use it in a year or less. So you record this at the end of the year as supply expense. So do we have any supplies? I don't remember anything, so let's move on. Prepaid insurance? No, we don't. How about prepaid rent? Oh, yes. Prepaid rent, we do. So how much is the prepaid rent, right? Prepaid rent, so let's talk about it. Prepaid rent is $36,000 for how long? Let's go back to our rental agreement. And on the rental agreement, it says prepaid rent is for 2 years. Okay, prepaid rent for 2 years. So let's calculate that. So $36,000 Okay, for how many months? For 12 months, right? $36,000 for 12 months. So that will be how much? Monthly. Equals to that number divided by 12, right? Enter. So that's $30,000 a month, right? So a year will be how much? Equals to that box times, where is my time? This is a times, times how many months? 12 months. Enter. Oh, wait a moment. 2 years, as I said? Oh, it says 2 years. Sorry. So 36,000 for how many months? That's 24 months. That's 1,500. So let's delete that. So for 1 year is that monthly rent times 12 months. That's $18,000 rent a year. Okay? So how much rent do you have to record for 1 year? 18,000. So let's go to worksheet. You see that? And this prepaid rent, the $36,000, has to be recorded as rent expense. So this $36,000 has to go down by how much? By $18,000 for 1 year. So this equals to, you see that calculation right there? Equals to that. So if the prepaid rent goes down by $18,000 on the credit side, because it's a debit, right? Has to go on the credit to reduce it, opposite of it. So this is 36 on the debit side. In order to reduce the asset by 18, we go on the credit side. If this is on the credit side, then something has to be on the debit side. You remember this is always, whatever you do in accounting, you have to do one-time debit, one-time credit, right? So if this is a credit, for God's sake, something has to be debit, and that is rent expense. You see that right there? You go right next to it here and say equals to that box, enter. And watch at the bottom, my debit side and credit side is equal. Fantastic. So this is my first suggestion, to record rent expense and to reduce the prepaid rent. Okay? So let's do one more. Just so you know here, how much cash do we have if there is no adjustment? If there is no adjustment, the cash we have equals to that box. Enter. In the adjusted trial balance, that's what we have. Prepaid rent, how much we'll have if we adjust it for 18,000. So here we go, equals to 36,000 on the debit side minus $18,000 adjustment on the credit side. So therefore the prepaid rent will end up to be $18,000. Let's talk about equipment. That's the next one. Equipment is $48,000. So let's go to see what was going on. It says equipment purchased for 48. The accounting management, they believe this type of equipment will have a 10 years useful life estimated. This is not rocket science, just estimation. In accounting, we use a lot of estimates, so this is an estimate. And residual value will be about $30,000 after 10 years if we try to sell this in a free market. So let's use that and calculate what would be the annual depreciation for this. So we bought this in January, so we used it for the whole 12 months. So it's not going to be that hard to calculate. So here we go. We got, let's say, $48,000. So that's equals to that $48,000. Yeah, yes, let's use that. So it equals to $48,000. So $48,000. And useful life is 10 years, it says, right? So that's 10 years, right? So also the residual value or salvage value equals to here $3,000. Okay, so the annual depreciation will be how much? This is how you calculate annual depreciation in a straight line method, which is the most common used type of depreciation, and it's the easiest one. So here we go. We call it equals to annual depreciation for this equipment that is getting older and older is $48,000. Okay, so let's put a parenthesis in here so we can separate that. So $48,000 divided by 10 years. But no, not that. Let's go back. $48,000 minus $30,000, the salvage value that you're gonna sell it after 10 years anyway. So that $30,000, it will come back to you. So you don't need to depreciate that. So annual is the original value, original cost, original total cost. And when I say total cost, it means the cost of equipment plus delivery, shipping, installation, sales tax, all those. That's total cost, 48,000. Divide the minus salvage value of, let's say, estimated 3,000. So let's put a parenthesis over there. Divided by that box, which is 10 years estimation. Enter. And that becomes $4,500. Cool. So the depreciation will be original cost, total cost, minus salvage value that you're going to receive that value later on when you sell it in the market. So the depreciable amount will be 48 minus 3. That means 45. So $45,000 is the depreciable amount, depreciable value. Depreciable value divided by useful life of 10 years, it gives you annual depreciation of $4,500 a year. And we bought this in January, right? So 4,500 times 12 months out of 12 months, that means still 4,500. So we don't need to do any changes on that. So let's go to worksheet. So we suggest that this equipment needs to be depreciated. So in accounting, according to GAAP, you don't touch equipment here. So don't touch it. But if I don't touch it, how do I depreciate it? And GAAP says create a contra account. A contra account is an account that is linked to the main account, as you see. It's right after it, 67, 68, as you see. And that contra account will provide the same reflection if you credit equipment, same thing. So in order to not touch equipment, you just credit the contra account, which you call it accumulated depreciation dash, let's say in this case, equipment. So you want to credit that, okay? So how much? Equals to, go to the calculation, $4,500 here, enter. So as you see, your accumulated depreciation will be here credited. That means if this is a credit, you need to debit something. So we call it depreciation expense dash equipment equals to that, enter. So all of a sudden, again, you see on both sides, I have the same balance equal. So how much equipment do I have in the adjusted trial balance? Equals to the original purchase price, total cost. And accumulated depreciation equals to original balance, whatever it's in here, which it was 0, minus, plus 45, enter. So my accumulated depreciation will be recorded in here. So now, what is my book value of the equipment at the end of the year? Book value of the equipment at the end of the year after depreciation, it's 48 minus 45. That's the net amount of the equipment. 48 minus 45 is 43,500. Agree? So if at the end of the year I sell this equipment for anything above 43,500, that would be a gain on sale of equipment. If I at the end of the year one I sell this equipment below 43,500, then it will be a loss on sale of equipment. Okay, is there anything to record about accounts payable? I need to talk to operating management. Looks like there is nothing to do on that. Anything for interest payable? Do I have any borrowing to record any interest, to recognize any interest that I need to pay? As far as I see, there is no borrowing. That means we don't have any interest payable to recognize. So I'm going to skip that also. Rent payable. Do I owe anyone for any rent? Do I need to record that? This is the time. And looks like no, I don't have any rent payable. So I'm going to skip that also. Dividend payable, I already recognized that, and the liabilities still exist. We didn't pay anything yet, so here we go. That will be on the credit side. This is where you normally make a mistake, so here we go. On the credit side, 22, enter, and dividend payable will be just transfer over there. Unearned revenue, it's a $65,000 liability. And I would like to talk to management, and the management says here in line 6 says on December 31st of 2014, unearned revenue balance is only 2,000. Wow, okay. So let's reflect that. So you see the unearned revenue is 65, but the management said it has to be 2. Okay, so how much do I need to adjust this? This is a credit. In order to reduce this to 2, I need to debit this. Here, I need to debit this. I need to adjust it, opposite of whatever it is. So here we go, equals to that box, 65, minus, the management says it should be 2. So I say, okay, that's 2 that I need to have it at the end, enter. So all of a sudden, that means I need to adjust unearned revenue for 63 $200,000. If that's a debit, then definitely in accounting, I need to have a credit for that amount. So what is the credit? Credit, we call it revenue. Where is it? Here. You see that revenue? Line 21? Huh? That's where it is. So I say equals to that amount, I'm going to recognize revenue. And again, at the bottom in my adjustments, as you see, 85.5, 85.5, both sides are equal. So let's transfer this information now. The unearned revenue is a credit of 65, but I have a debit of 63. So my leftover is a credit leftover equals to 65 minus 63, enter. Oh my goodness. That number now in the adjusted trial balance is exactly what my management said, which is $2,000, and I have it now. So this is the reflection of my management discussion in regards to balance of unearned revenue at the end of the year. Perfect. Any questions so far? Life is good? Okay, let's keep going. Long-term liabilities, we don't have any to recognize, no problem. Common stock, it's the same thing. There is nothing changed in common stock. So I'm going to say no change. So here will be equals to that box, enter. In regards to dividend, still is the same situation, nothing changed. So equals to dividend. There is no adjustments on that. Revenue, there is no more revenue to recognize. If there is any, I would, but there is nothing at this moment. Maybe your management says, oh, there is one job that we just did yesterday. How much? $200. Okay, so you increase debit of accounts receivable, adjust here, accounts receivable $200, and then you increase the revenue by $200. You create another line here, right click, insert, leave it blank, and you put that right there. Let's say here. Let's say your management says, yesterday we did one job and we finished it. We need to send an invoice. Oh, thank you for reminding me. So here we go. You say $200 here, right? And then this is equals to that box, enter. And you see your revenue has been just increased by $200. That's the last moment adjustment. Of course, we need to send an invoice. So we're going to send an invoice to this client for $200. So we get paid. We didn't get paid yet. We just finished the job. That's why we need to recognize it. In accounting, whatever happens in the 2014 stays in 2014, just like Vegas. Whatever happens in Vegas stays in Vegas. Same thing in accounting. Whatever happens in 2014, you have to recognize it in 2014. If something happens in 2015, then you recognize it in 2015, and so on and so forth. So, but this is not true. I just made an example for you. So let me reverse this, reverse it. Okay, and reverse one more time. There you go. So revenue is nothing changed. So here we go, equals to 63,000, enter. Accumulated, depreciation expense is same, debit, nothing changed. So here we equals to that, enter. And wage expense, we don't have any to adjust. Utility expense, nothing to adjust. So we're gonna take that utility expense from here, debit side, put it on the debit side. And rent expense is debit. Again, here, there's no rent expense previously recorded. So I'm gonna just record equals to $18,000, enter. And as you see, at the end, my adjusted trial balance will be 441,500, 441,500 on both sides of debit side and credit side of adjusted trial balance. So worksheet is a very good way to make sure you go line by line and all your adjustments, 1 or 20 or 30, doesn't matter. All your adjustments will be done in worksheet. Later on, next time, we're gonna finish this income statement and balance sheet. And your job is at this moment just to practice exactly what I did on paper, on Excel. So watch this video as many times as you want, back and forth, and then copy this document on a blank paper. Do it on paper first, see if you are comfortable with the knowledge, and then go back, do it on Excel the way I did it, okay? And practice it. I cannot practice it for you. I would have done that if that was possible, but the only way you can learn is just practicing, okay? That's the only way you learn. So we have two types of adjustments, the main type of adjustments that we call it deferral adjustment and accrual adjustment. So let me type it here. Let's say deferral, I believe maybe 2R, and the other one is accrual adjustments. So what's the difference? Deferral adjustments are adjustments that we received or paid cash in advance, and now we need and we deferred the recognition of revenue or expense to future. Okay, so this is what deferral adjustment is. So deferral adjustment is an adjustment So deferral adjustment is an adjustment that it's in regards to a cash either received or paid in advance, and we deferred the recognition and we received or paid cash in advance, and we deferred the recognition of revenue or expense to future, which is end of the year. Make sense? So an example maybe I can have here. Let's say here, we paid, you see prepaid rent, we paid cash in advance, and we deferred the recognition of expense to future. And future is now at the end of the year. Or here, let's say here, we received cash in advance and we deferred, we call it deferral revenue or unearned revenue. And we deferred revenue, recognition of revenue to future, which is now. end of the year, and we're gonna recognize proper amount of revenue. So that's what deferral adjustment is. So that's a deferral adjustment. Accrual adjustment is no cash paid or received. So no cash paid or received. However, something happened or accrued because of passage of time, let's say. So something accrued here. No cash paid or received. However, something happened or accrued because of passage of time. An example that here I can say kind of it's related to that is equipment. You see, when you have equipment, you might say, oh, okay, passage of time. So we use the equipment and now we have to recognize a proper amount of expense. The other example is, I don't have it here, but let's say many years ago, you borrow money or you purchase a home or something, and you have a note payable or a mortgage payable, and that mortgage or note now is accumulating interest that you need to pay. So you have a liability, we call it interest payable. So because you borrow money sometime in past or bought something in past, let's say truck or something. So that interest is now due and you need to, because of passage of time, so the interest now is due and you need to calculate how much the interest is due so you can pay that interest. So in order to calculate, let's say interest, you will say the interest principal, the liability principal that you borrow, let's say $100,000. And passage of time, how many months passed? Let's say 6 months ago. So you say, and how much is the interest rate? Let's say 10%. So 10% of 10% times $100,000 principal, that will be $10,000. But you borrow that, let's say, or for some reason, that was 6 months ago. So $10,000 times 6 out of 12, 6 divided by 12, and that will become $5,000 interest payable. And here you record, here, credit interest payable. No, which one? This one. Credit interest payable, right? And here you say debit interest expense. And that's an accrual adjustment. So at the end of the year, companies they have two types of adjustments to do. Either accrual adjustments or deferral adjustments. Okay, and we got a few examples here just to warm up. Okay, so the next step is preparing income statement and balance sheet in the worksheet to see what's going on, at least as a preview. Okay, so let's look in the worksheet. In the income statement, I need only revenue and expense. That's it, nothing else. Revenue minus expense equals net income. Okay, so let's see where is my revenue here. You see here, revenue is starting from 401, right? So let's go. Equals to revenue, enter. Okay, and here I go, those are expenses. So equals to that expense enter, equals to that expense, enter, and equals to rent expense, enter. So it looks like below this line, you see that thick line here? Those are all my revenue and the expenses, looks like. So I just copied them in here. And because I used the formula with the fill handle, I put it all the way to the right. Remember that? So using that fill handle, I pulled the formula to the right, and all my boxes now, they have that same formula that they're adding up the whole column. So here the whole column is 63,000, and my expenses are total 34,500. Okay. Now you go below expense. One more time. You go below total expense, and you say equals to, and then say revenue, whatever it might be, minus total expense, enter. And that is a positive number. That means my revenue was bigger than my expense. Therefore, it's a 28,500 positive number. We call it net income. So either it's net income, if it's in the parentheses, that means it is loss. But in this case, it's an income. Very good. But remember, we need to have both sides equal in worksheet when we are working, so we don't make a mistake. Okay, so let's go here, and I say 0 equals to total expense plus net income, enter. Cool. And I do the same thing now. I grab this fill handle, I pull it to the right. So the same formula applies. I-32 plus I-33 equals 63. And both sides are equal, 63 and 63. So there you go, double line, $sign. So I'm good. So it looks like my income statement will be something like this. $63,000 revenue minus few expenses, and I will end up to have a net income of 28,500 on my worksheet. Remember, this is not official income statement. This is just a preview. Okay. Then whatever else is remaining in adjusted trial balance, whatever, just copy it into balance sheet. Simple as that. So here we go. Equals to that box, enter. All right. Equals to that box, enter. Cool. You see what I'm doing? Equals to that box, enter. You see this has a formula like that. I can grab that box and fill handle and pull it down, and everything will be transferred here from this box to this box. But because I don't want those zeros, it might be right now a little bit confusing. So I don't like to do that. It's not a big deal. So let's not be lazy and go to the next box and say equals to that box, enter. But you could have just from here grab the fill handle and pull it down, and everything will be transferred, but the ones that has nothing in it here will show as a 0. That's why at this moment I don't want to do that. But if you have a very busy lineup in here, just do one, grab the fill handle and pull it down, and all this formula will be transferred, same as this box, whatever that formula is, will be transferred to the other boxes, and life is good. So here I have equals to 4,500, enter, it's a credit. So here I go credit equals to this credit equals to that one equals to this, and that's it. Yeah, nothing else. So now watch at the bottom. This is not equal, is it? No, oops. So now what? This is where you work to make sure that the whole thing you did in here is kind of done properly. So here, see how you check your work. So now, watch this carefully. You look at the result of revenue minus expense. It might be net income, it might be net loss. If it's a net income, which is a positive number, as you see, then you transfer that, copy that positive number below smaller number in the balance sheet. One more time, if this is a positive number, which is net income, it's not a net loss, it's net income. Copy that, because it's a positive number, copy that below the smaller number in the worksheet. If that number, it's a negative number, then copy that below the larger balance in the balance sheet. Okay, so but for now, this is a positive number, so I'm gonna copy it below smaller number in the balance sheet, and here we go. Cool? And then I'm gonna go ahead here, you see this one has a formula. I'm gonna grab the fill handle of this box and pull it to the other side. And now, you see 378 plus 28 is 407. 407 plus 0 is 407. 407 is equals to 407. So my balance sheet is balanced. This is how you check your work. If this $28,500 cannot make this both sides equal, then you made a mistake somewhere. This $28,500 should make your balance on the debit side and credit side same thing in the worksheet. As you see, it did it. So my job is good. I didn't make a mistake. Life is good. Here we go. I don't know why this is red, but okay. Any question? No? Okay. So the balance is ready. Now, my accounting team and my management, they look at this. We all have a meeting, and everyone says, fine, everything is fine. Specifically nowadays, if you know, they want, if the companies they want to work remotely, definitely they go through a online meeting, and then they look at this remotely. Maybe some managers are in other locations or for some reason. So here we go. Now I'm gonna use these suggested adjustments to do the end of the year actual journal entry, okay? So my suggested adjustment is prepaid rent, $18,000 here, credit, and rent expense debit. Okay, let's go. So go to adjusting entries for December 31st of 2014. If you use a QuickBooks, and you want to do the journal entry, there's a box that you have to check that box. By checking that box, you are saying that this is adjusting entry that I'm doing. So imagine this is a QuickBooks, there is the box for adjusting entries, and just I click that box just to show that these are all adjusting entries at the end of the year. Okay, so here we go. I say debit what? Let's remember again, debit what? Rent expense, debit first, credit last, right? So debit rent expense, right? You see that? And credit prepaid rent. Okay, so here we go. Debit rent expense. So if this was QuickBooks again, there's a box in here that where the cross is, and you click that box and the drop down menu will open, chart of account. You choose your account that you like to put as a debit. Here I don't have such a drop down, account, so I just use typing. So, but debit what? Debit how much? Equals to, go to worksheet, click on that box, enter. Got it? Now, the other one is indent. In QuickBooks, you don't need to indent, but here in a classroom environment, we indent just to show that it's a credit. So this is prepaid rent, okay? And credit equals to, go to worksheet, and that's the prepaid rent, and enter. Fine? Good job, huh? Okay, so now that you did the journal entry, what's the next step? Remember that? Save and new, right? Because you want to do another one. So let's save it. That means post it. Okay, let's post it. Post it where? In the T account. So prepaid rent expense, I don't have one. So let's create rent expense. What was the account number for rent expense? Let's go to worksheet. That was 643. So let me, 643, that's the account number. Okay. So rent expense, normal balance for any expense is debit, so equals to, let's look at the debit of my rent expense here. And enter. And all of a sudden, it's right there, and that's the formula, B37. Prepaid rent, I have it right there. It has to be credited, so go to credit, say equals to, and that's a credit right there. Click enter. And now we have prepaid rent. So what's the balance right now in our prepaid rent? The balance in the prepaid rent, so let's draw a line. And say equals to debit side. Asset is always normal balance debit, right? Asset, normal balance debit. The asset minus the credit side, enter, and the balance is 18,000 because this is our final answer. So let's make it like $1, looks better. There you go. Life is good. Okay, so now let's do one more. We have, I believe, few adjustments to do. So let's look at the worksheet. The next adjustment we want to do is accumulated depreciation dash equipment should be credited, and depreciation expense dash equipment should be debited. Okay, so let's go. So depreciation expense dash equipment. So depreciation expense dash equipment, that's a debit, equals to, go to worksheet here. You see it's a debit side. In accounting, debits first and then credit last. Okay, here we go. Debit first. The next one, let's do some indent. It is accumulated depreciation dash equipment. Okay, accumulated depreciation dash equipment. That's the contra account to the equipment. That's where you accumulate all your annual depreciations. So equals to, go to worksheet, and that will be that box. Enter. Okay. And you need now to do what? Post it, right? So click Save and New in QuickBooks, let's say, and post it. Here we have to do it manually. So accumulated depreciation. So let's see. This is my equipment, but I don't have depreciation expense or accumulated depreciation. So let's go. So this is my depreciation expense dash equipment with an account number. I believe it's 168. Oh, depreciation expense? No, depreciation expense is not 168. Let's look. Depreciation expense 612. 612. 612. Okay, so debit depreciation expense equals to, go up, click on that depreciation expense, enter. Okay, and this one is accumulated depreciation dash equipment, right? Dash equipment with an account number, what was that? 168, I believe. 168. Okay, that's a credit. You see depreciation expense, normal balance is debit, yes, but accumulated depreciation is contra account to equipment. So it's opposite of asset. Asset is debit, this is always credit. Equals to, and then we go up and click on that, enter. Cool. Any question for me? No. Let's go. So far, I have all my balances lined up. pretty much. Okay, so no problem in here. I've done 2 adjusting journal entries, and I have 1 more to do. So let's go. The next one, let's look in the worksheet. The next one says debit unearned revenue or deferred revenue for 63,000 and credit revenue. Okay, let's do it. So debit unearned revenue or deferred revenue, and that's a debit, equals to, go to worksheet, get it from your worksheet. You see all those adjustments are coming from worksheet. I'm not typing any of those. None of those are typed. And this one is, let's put some indent, revenue, and it's a credit, equals to, go to worksheet, and that will be a credit of $63,000. Enter. Cool? Okay. So don't forget to post this, save and new. So it's not a QuickBooks, I have to do it manually. So here we go, post, save and new, and then I go down and where is my, here, unearned revenue, do you see that? So it's a debit on unearned revenue, equals to, go up, debit unearned revenue, enter. And credit revenue, okay, and revenue, the balance is 400 something, I believe, 401. Yes. So revenue is account number 401. Okay, and that's a credit, equals to, that box. Cool. So revenue now is $63,000. Unearned revenue, let's calculate the balance. So here we go, equals to, oops, no, this is wrong. Wrong. This side. Why? Because unearned revenue, it's a liability, and credit side is bigger than debit side. So I have to be on the credit side. So let's put a box in it, that one, and then say equals to the credit side, which is a big number, minus the debit side, and the number is $2,000. Voila, that's exactly what we have to have, right? So now everything is looking fantastic, I believe. Okay. So adjustments are done. No more problem on that. What we need to do now is preparing adjusted trial balance, but I don't want to do it because I already can see my adjusted trial balance in here. So it's not necessarily to do that. So I can have this anyway. So, but what we need to definitely to do is preparing what? Financial statements. Yes, I have a preview here, but I need to prepare financial statements, official one. So let's go and here, prepare financial statement. So this is the ABC Inc. income statement, and you have to have a date, let's say for the year ending December 31st, 2000.